What's up, guys? Mike Sharp here again. This is Sharp Investing. Another Flow Traders video. They had a really exciting Q2 release on Friday. The stock dropped 20%, and I will tell you why I think that that's a good thing. In the meantime, just reminding you, I do have a Twitter account now, Sharp Investing 1, and if you want quicker updates on the stocks that I follow, I usually try and post something after the earnings are released, like I posted yesterday, right when Flow Traders was released, and I'm not able to keep up on all the videos every time there's earnings released. So follow me there if you are interested. I guess what we should start off with, before we get into the exciting reasons why I think this is a good report, even though the market hated it, I think let's just do a quick review of the thesis for Flow Traders. Now, Flow Traders is a little bit of a counter-cyclical position. It does well in high volatility situations, which basically means crashes, right? Or fast bear markets, let's say. Like 2022 was a sort of a slow trip down the stairs. You know, they usually say the market takes the stairs up and the elevator down. So we just basically, I'm waiting for an elevator down moment, and I believe it is coming at some point. I don't know when, but I think it's coming because they always come back, as far as I can see. It is basically it's trading at pretty low priced earnings. But if you look at historical numbers, now I'll show you here. Let's see, where are we at? 2020, they actually made 570 million in pre-tax earnings, and that's right now the company's trading at 650 million market cap. So you can see that in a really volatile situation, they can make a ton of money. In 2021, 22, they kind of averaged 150 million, which is, I don't know, what's that, less than five times, 4.5 times the current valuation, pre-tax earnings. You know, so it's pretty cheap. Like, because last year was low, right? They made 45 million because it was just, the market just grinded upwards for the whole year. And that's sort of a low year, right? So I'm buying at, or I own at about, what, 13 times that, 14 times that in a bad year. So I think it's pretty cheap historically. You just don't know when the good years are coming. So like I said, I like that it adds a hedge component. If there's a stock market crash, I know one of my positions will do well while everything else gets destroyed. And then I can use that money, if it does well, to put into the cheap stuff when the market's down, right? So it's a little bit, helps me out that way. Theoretically, anyway. It didn't work in 2022. One of the things I love about this company is a very high incremental margin company. If you watch my videos, I love these kind of companies where they have a fixed cost base that's most of the cost, and then any additional revenue, a lot of it falls to the bottom line. So they have a very and I'll go into that when we look at the quarter numbers, and also they're growing under the hood, right? Like, they've added crypto products, they've added currency, fixed income products. So they're expanding into all these different products. They used to just be equity exchange traded products in Europe, and now there are all these other assets and different geographies, right? So they're now in Asia. They have a presence in North America as opposed to just Europe. So they're expanding quite a bit over the last few years, and we just haven't seen the fruits of that because we haven't seen a high volatility moment, and also because interest rates are higher. Like, the higher interest rates actually hurt their bottom line. So high vol, low interest rates, they will do extremely well. If you don't believe that's coming, not the stock for you. So let's talk about the earnings quickly, I guess. What do we want to go over here? Okay, so we'll go over the general numbers. They had 76 million in net income, total income, net trading income. That's up 48% from last Q2. Now that's a bit of a trick because it looks great there, but Q2 last year was actually the worst quarter on record, right? It was extremely low volatility. There was no action anywhere in the market, and they just grinded along and just basically paid their fixed costs. But if we get into, well, I mean, if we could look at the geographies, I don't think this is that relevant either. These numbers are that relevant. Maybe the first half numbers are a little bit more relevant, but again, it's not a linear growth process with this company. So check, comparing versus quarters doesn't really add a lot of value. But basically, they're still trying to grow in all these markets. You can see the U.S. and Asia are still pretty low, but that's pretty good. They just opened their office last year, so second office actually. So that looks pretty good on them. The operating expenses, now here we're talking about the incremental margins. The operating expenses are the interesting thing here. Look at that. It's only up 7 million, even though the the trading income was up 25 million, right? So you have a 7 million increase on 25. And if we back out this one-off expense, it's basically 25 million of income versus 9 million of incremental costs or variable costs for that extra income. And that's why when the income goes up, they make tons and tons of money. You can see even in quarter 2 here, where they only made 29 cents, which is that's a pretty low average quarter for them. Their EBITDA margin was still 28%. And first half was 40%, and last year, even though it was a bad half, they did do 27% EBITDA margin. Now the EBITDA margin it's more relevant with this company than usual. Like usually it's just like earnings minus a whole bunch of tricky stuff so that the management can make it look good. But essentially here it's mostly just net income and then back out, I think, taxes and depreciation. So it falls pretty close to the pre-tax number. So if you're looking at, this would be like a pre-tax margin kind of thing. They run about 17 million a year in depreciation, and the average is about 14 million for CapEx, and like let's say 10 for CapEx and then 4 for acquisitions, because they acquire smaller companies to sort of add to their portfolio. So let's go through the slide deck quickly. Like I said, here's the EBITDA for the first half is 82 million. That's pretty good. You can see their exchange traded product value hasn't actually gone up this year. So that's a little concerning while the whole market is increasing. So that's a bit of a concern there. And then for the net trading income, like I said, first half 76. That's last quarter, and then for the first half was 205 million. Now, if we go over to, I think I showed that already. Okay, so EPS for the first quarter was €1.35, and like even if they have a kind of a slow quarter, if the market doesn't do anything for the rest of the year, they'll probably get this up to about 2. In which case the company's trading at 7.5 times earnings when it's trading at €15 like it was on Friday. So for me, I like buying when there's problems and people are selling. So I'm pretty comfortable owning this right now when people are not happy. If we go to let's fast forward here to the crypto page. So we've got 109 million of exchange traded products for crypto. That was because the Bitcoin ETF got approved in quarter 1, and you can see the difference it made. Now they don't break out the individual earnings from each of the categories, but I think that crypto is now adding a decent amount to the bottom line, because last quarter, equities and fixed income, like they didn't do a lot. So I'm guessing that the crypto portfolio actually added to the earnings in a decent way. Okay, so if we go to what's this? This is the fixed expense page. Like I said, or maybe I didn't say. So they've got about 45 million a quarter in fixed costs, right? And then so once they get above that, the margins are kind of like 60-70% on incremental net trading income, right? So basically, you can see here first half, 89 million for the first half. It's down a little bit from last year, so they're managing it. But you can see a scenario where if they hit their target of $1 billion in net trading income in the next few years, you could see a scenario where, okay, you've only got 60 million in 180 million in fixed cost, and the rest is at a very high margin. You could see 4 or 5, maybe even 600 million in pre-tax profit on that, right? And that's just on a 650 million market cap. But back to the cost efficiencies here, you can see the headcount is dropping over time. So this has sort of helped them offset the wage inflation that we've all seen in the last few years. It also shows that they don't really need more people to expand. They don't need a lot to expand, right? They might need to buy other companies to sort of add to their portfolio skill set, but they have this software that they seemingly can layer across a lot of different products and without actually adding a lot of infrastructure or people. So that is that's a winner in my book. You see, like, it's actually bigger as a business with less people. What's this one? Return on trading capital. So this is we'll get into the trading capital stuff now. You can see they have a very high return on their capital. So they've got 624 million in that they can use to trade, and they're producing a 56% return on that. That's annualized net trading income, right? So that's not bottom line, that's top line. But the bottom line number is, you could take their net income and just divide by that, divide over this number. And you can see here the dividends they've paid over the last few years, they're pretty substantial. But what they've done is, obviously, we all know, if you're watching this, you probably know that they've cut the dividend. And, maybe they're watching Sharp Investing. Maybe. Hey, guys, if you're watching, thanks. Great job. Probably they aren't. They've probably got better things to do than watch a nobody talk about their business. But, cutting this dividend is fantastic. I can't make 56% on my money. Like, if you give it to me as a dividend, like, even if that turns into 20% bottom line number, like 20% is a pretty good return. Like, maybe it's 25 in a good year, 30%. Like, and so I was I said, just keep it, guys. You keep those dividends. And, I'm really happy that they've done this. Now, obviously, the stock crashed by 20%. So all the dividend investors, the people, and maybe there's funds in there and they can't hold the stock anymore because it won't pay a dividend. So they've just everyone's just jumped ship and crashed the stock. I actually think it's a better stock now. I think it's a better company now because, like, if you match, keeping the return on capital with the additional capital they're going to have now because they're not paying out these dividends, like, the company's actually better now. We can expect higher returns in the future. On top of that, they've also added a $25 million term loan. So last year they paid about 47 million in dividends. Right there, it's 47 million. And if you add 25 million in a term loan to that, and say that's 60%, 60 to 70%, you're adding 40 to 50 million in pre-tax income just from not paying out the dividend, right? So now it is turning into a compounding machine because the fixed cost expense is going to be the same, and that that 70 million more in trading income is just a lot of the income it's generating is dropping to the bottom line. So I think if we go to CEO's comments, if I can find them. So over the past 18 months, Flow Traders made a concerted push into new markets, asset classes, and geographies with considerable success. Following the arrival of a newly constructed board, we have conducted a broad-ranging strategic review and concluded that we have a significant opportunity to capitalize on this period of development and move Flow Traders into a growth phase. What is the stock market like the best? Growth, right? So if they see opportunities to grow and they're going to keep the capital in order to do that, I think that's really good for the stock price. I don't know when, but I do think it's great. Now, I should just remind you, this is not investing advice. This is what I'm doing with my money. I don't know your circumstance. Do your own research, please. So development of our trading capital base. So basically what I've just been saying, they're going to keep the money because they can earn a huge return. I like that they're getting a loan too, because this is a pretty low risk business, has big margins. The interest on that loan is not a big deal to them. A couple of million here and there. I would actually like them to push that to 200 million, and turn loans up to 200 million, and just let's roll. Because as I said in the last video, one of the things that they said previously is that they're not able to take advantage of all the opportunities. They flow capital into what they feel is the best return on their money at any given time, but they're not able to do all of the things. So maybe they do 1 and 2 on the list, but they're not doing 3, 4, 5 that maybe don't have as good returns, but they still will be profitable. So now they're going to have more capital to deploy. Maybe not as big of margins, but I wouldn't bet against it either. So basically, I think this is a great quarter. I think this is, for me, creating a buying opportunity. I might take advantage of that. I'm not promising anything. I'm still thinking about it, but well done, Flow Traders and CEO Mike. Great quarter, and thanks for taking us in this new direction. And thanks to you for watching. Again, if you got this far, I appreciate it. And if you want to hit like, that would be awesome too. Thanks, guys. We will catch you in the next video.